Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. We are looking at the Market and Policy Dynamics Report for May 6, 2026.
This video presents a direct informational narration of the source document, so let's dive right into the data. Today, we're moving sequentially through a 5-phase matrix straight from the source intelligence. We've got geopolitics and energy markets up first, then we'll hit Treasury yield interventions, broad market index analysis, take a granular look at equity earnings, and finally, we'll wrap up with closing market updates.
Let's start with Section 1, Geopolitics and Energy Markets. We're kicking off with the macro geopolitical developments that are directly impacting Middle Eastern stability and global energy pricing.
So, check out this proposed agreement. It is remarkably concise, literally a minimalist 14-point framework that effectively fits on a single A4 sheet of paper. It dropped with a strict ultimatum, a 48-hour window for a final response. The core terms? The U.S. lifts sanctions and releases billions in frozen funds. In return, the Freedom Project gets paused to ensure transit through the Strait of Hormuz without any blockades. Once signed, this kicks off a 30-day negotiation period in either Pakistan or Switzerland for a broader nuclear agreement.
But here is the catch. These relatively soft terms are clashing hard with an unyielding stance from Israel. Statements indicate constant preparation for escalation, demanding the complete removal of all enriched uranium materials and the total elimination of uranium capabilities, completely regardless of this proposed memo. Now, the market reaction was immediate. Right after the news hit, WTI crude oil dropped over 2% intraday, heavily liquidating leveraged long positions. To put that into perspective, U.S. oil prices had already surged about 50% since military operations began back in February. So this diplomatic move effectively acts as a targeted PR intervention. It suppresses oil bulls to keep energy prices down so that anticipated rate cuts and midterm election prospects don't get derailed by inflation.
Moving right along to Section 2, Treasury yields and interventions. We're pivoting strictly into domestic monetary mechanics here.
The scale of institutional intervention we are looking at is just massive. Since December, the Federal Reserve has scooped up $237 billion in U.S. Treasuries to support the bond market, pushing total assets on the balance sheet to $6.7 trillion, the highest we've seen since May 2025. Honestly, without this combined effort from the Treasury and the Fed, the 10-year Treasury yield would have likely surged well past 4.5%.
This builds into what bond traders actually call the taco trade. The timeline shows 5 distinct, repeated instances where major policy announcements coincided perfectly with the 10-year yield approaching that 4.5% level. Look at this sequence. April 2025, tariff fears push yields past 4.5%, so a 90-day tariff pause is announced. May 2025, it approaches 4.5% again, and a China trade framework drops. July 2025, right at 4.5%, the tariff agreement is extended. Late March 2026, an initial ceasefire is announced, and now in May 2026, Hormuz friction pushes yields to 4.5%, immediately followed by this A4 memo. Every single time, yields drop sharply and equities rally. It's like clockwork.
So, what is so special about 4.5%? Well, it's perceived as the U.S. economy's critical load-bearing wall. If yields break above 4.5% due to disorderly fiscal expansion or bond oversupply meeting weak demand, it signals systemic financial pressure, not healthy growth. Because systemic leverage is so incredibly high right now, heavy-hitting news is actively deployed to hedge against this exact red line being crossed.
Let's transition to Section 3, Broad Market Index Analysis. We need to look at the technical postures of broad market indices amid all this geopolitical noise. Just look at the QQQ's parabolic upward trajectory since March 31st compared to real-world events. It's wild. The market completely shrugged off severe geopolitical shocks occurring on the very same day, including military strikes in Lebanon and U.S. jets firing on an Iranian oil tanker. Unless the 10-day moving average is broken, the QQQ might just surge directly toward that $700 yearly resistance level without a normal correction.
Meanwhile, the S&P 500 gapped up, crossing the 7,300 mark and entering the 7,308 to 7,377 range. Based on Bank of America analysis, this specific zone represents the blow-off-top phase of the current liquidity release. That essentially means correction risks are going to gradually increase from here.
Let's dive into Section 4, Equity Earnings and Movements.
We're going to get granular with individual stock performances right from the source data. Starting off with AMD, the stock posted a massive 18.6% surge, leaving a huge gap up on the daily chart. The momentum here is extreme. It literally hasn't even tested its 10-day moving average since April 2nd. This price action is heavily driven by absolute FOMO and strong trend momentum, routinely ignoring fundamental catalysts until the trend finally exhausts itself.
Next, Arista Networks saw a heavy pullback. Despite a really strong Q1 with revenue up 35% and adjusted EPS up 34% year over year, the Q2 outlook only met expectations. But more importantly, Q2 operating margin guidance was set at 46% to 47%. That is noticeably lower than the 48.8% from a year ago. With sky-high valuations built purely on AI expectations, failing to exceed those margin targets prompted an immediate valuation pullback.
Then we have Hut 8 Corp spiking 35.3%. They just secured a massive 15-year lease agreement with a guaranteed value of $9.8 billion to provide computing power to an investment-grade company. This marks a major pivot from Bitcoin mining into AI data centers, though you have to note the price action remains speculative, given the company's political connections through its ABTC holdings. While Disney reported an earnings beat with Q2 revenue up 7% and the streaming business actually achieving double-digit margins for the very first time. They guided for 12% full-year adjusted earnings growth, and while the stock rose over 7% on the news, it is worth noting Disney's broader underperformance. It was actually down 12% year-to-date prior to the print, compared to the S&P 500's 29% gain.
Novo Nordisk presented a really stark contrast in its metrics. On one hand, Q1 revenue dropped 10%, missing expectations due to pricing pressure. Conversely, net income surged 67%, significantly beating estimates thanks to cost optimization and strong Wegovy sales. Management narrowed their 2026 sales decline guidance to between 4% and 12%, but that wide band signals some ongoing uncertainty in the GLP-1 pricing environment.
Uber's Q1 revenue grew 14% year over year, slightly missing expectations due to sluggish 5% growth in mobility. The dominant data point, however, was a $1.5 billion paper loss from the devaluation of Didi and Grab equity holdings. That dragged net income down to $263 million from $1.78 billion a year ago, resulting in a severe EPS miss of 13 cents. But get this, despite all that, the stock rallied 8.4% as the company issued highly aggressive gross bookings guidance of $56.25 billion to $57.75 billion, blowing right past market estimates.
Let's look at a stark divergence in tech results. Upstart reported Q1 revenue up 44.5%, but recorded a net loss and issued a weak 2026 revenue guide. Their ongoing decline stems from macro headwinds and a failure to clear loan balances from their balance sheet, leading to Wall Street abandonment. Conversely, Supermicro saw Q3 revenue surge an incredible 123%. While top-line revenue slightly missed, adjusted EPS crushed estimates. The massive catalyst here? Adjusted gross margins exploded to 10.1%. Coupled with strong Q4 guidance, the stock soared over 24%.
Finally, let's jump to Section 5, Closing Market Updates. We'll run through the last sequence of market speculations and geopolitical notes. Alibaba experienced a gap up in price action today. As noted in the report, this was driven entirely by market speculation regarding potential upcoming political and diplomatic visits to China, rather than any immediate fundamental news.
To close out, keep a close eye on highly volatile after-hours earnings reports pending from Coherent, ARM Holdings, and AppLovin. And as a final, isolated geopolitical note, Iran has committed to pausing its uranium enrichment activities. So, with geopolitical friction seemingly managed by the A4 memo and the Fed actively defending that 4.5% yield wall, the big question remains: is the market's parabolic surge a sign of true systemic resilience, or are we staring at a blow-off top waiting for a catalyst? Let us know what you think in the comments below.